My name is Greg Reardon. It's great to be here. Thanks so much for having us. Today, what I'm going to talk a bit about is an overview of the new plan design. Okay, so we talk about it as the variable benefit plan, so that is the new plan. Just a little bit of background with the current plan. Okay, so when we talk about the current plan, that's that 2% times service up to 25 years, so there's a service cap, and then times a final average earnings, and that's a high 5-year average of salary up to $260,000. You may also be familiar with the flat dollar benefit as well, but both formulas yield the same benefit. After 25 years of service and after hitting that 260 pay cap, the current pension plan provides $130,000 annual benefit. So in contrast with the new plan, there is no service cap. So every year a pilot flies over 25 years, their benefit would increase. And there is no pay cap. So any earnings over 260 is considered in the new plan. With a caveat though, this new plan is a qualified plan. And so for IRS purposes, there are certain compensation limits that need to be reflected. So for example, the total compensation that could be reflected for a 2018 benefit accrual is $275,000. And that IRS limit does get ratcheted up with inflation in the future, and the IRS publishes that limit every year. But as you can see, it's currently already over the 260 cap, which is one of the problems with the current plan. In the new plan, benefits are adjusted based on investment return, hitting a target hurdle rate. And when we talk about investment return, we're not saying that the pilots need to do their own investing and whether or not they're going to hit a hurdle rate. So the investment, you're not taking those investments on your own back. FedEx Corp is not making those investments either, and nor is Alpa making those investments for you. There are investment professionals, so investment consultants, investment managers, professionals that would be making the investments and running the total assets that come into a pension fund and get invested. Once a pilot retires under the new plan, that benefit can either be locked in, so fixed, or it can continue to vary with investment return in the future. And we see that, one reason why a pilot may want to continue that variation is to capture cost of living adjustments or inflation adjustments into retirement. So we talked about how under the new plan benefits would increase or decrease based on investment return running up against a hurdle rate. So how is that captured in the benefit? So the IRS actually tells us in regulations how that is worked out. And so you could think of it as a mutual fund. We talk about shares and share price, but you think about it as a hypothetical mutual fund where you would earn a certain number of shares each year, and then your benefit at the end of the year is simply the shares that you have accumulated times a share price. And this is hypothetical, so it's not like you have an actual mutual fund or stock and trading, but this is how the accounting is for in terms of the variable benefit plan. And again, the benefits go up or down based on investment return. And how that works is we compare the actual investment return in the pension trust against a target hurdle rate. So for example, when we run some analysis, we're going to be using a 5% hurdle rate. So if the investment return is 7% over the 5%, so we have a 2% excess return there, and so share prices would increase that 2%. And then you would multiply a higher share value times the number of shares to get a benefit. And we'll go through some of that math shortly. So we talked about how in the new plan, benefits can be decreased, okay, if the investment return doesn't match up against that 5%. So no one likes decreased benefits, so the new plan will have downside protection. So one area of downside protection is a floor benefit. And so what that says is, okay, you have your variable benefit going up or down with investment return, but it can never decrease below a certain floor guaranteed benefit. So the pilots understand, hey, no matter what happens in the market, I am guaranteed a certain floor benefit. So that's one downside protection. Another protection is the concept of a stabilization reserve. And so what that says is there is part of the assets that will be used in the event that there's an economic environment that would call for a decrease in benefits. So rather than decrease the benefits, the stabilization reserve would kick in, fill up the gap there, and the benefits would remain level. And how do we fund these protections? Really with defined benefit pension plans, it's just cash coming in as well as investment return. So it'd be cash, it could be investment return, it could be one or the other, it could be any combination of the two. And there's certain other combinations of how you can fund, for example, contributions, all up front in a lump sum contribution, trickling in over years, or a certain percentage of payroll. So there's different types of funding vehicles. In terms of the investment return, we can look at putting a cap into the plan. So for example, a 10% cap. So any investment return over that 10% cap, rather than increase benefits, it could go and fund a stabilization reserve. So on this slide, we have a couple of examples, and this is in line with what we just saw in the video, with that small caveat that we had rolled in an extra year of investment return. But on this slide, we show 3 different hire ages, age 25, 35, and 45. So these are new hire profiles. The salary in year of hire is the 73,530, and that's what a new pilot could expect to be receiving in year 1. And there's retirement scenario 1 on the left-hand side. That is if a pilot flies from hire age all the way to age 60 and then retires. And then the box on the right is the retirement scenario 2. So that's if a pilot continues to fly an additional 5 years and then retires at age 65. And when we ran these projected benefits, we assumed a 2% floor benefit in the new plan. So what that means is that floor guarantee is 2% times pay up to the IRS limit each year. It's like pancakes, and you keep on adding up the pancakes each year. And so a pilot's benefit could not be less than that stack of pancakes each year. We compare that to the variable benefit and take the greater of the two. In terms of investment return, so the variable benefit will go up and down with investment return. So for purposes of these projections, we assume that the investment return would start out with 1999 investment return all the way through to 2017 return, and then earn 5% thereafter. And how we mirror 1999 through 2017 is we take a look at the S&P 500. We say, okay, portfolio is going to take half stock, 50% stock, and then 50% fixed income, and we combine the two to get an actual return based on historic data. The hurdle rate is the 5%. Okay, so that's the target expected return. So any time that in the past there was an investment return over that 5%, the variable benefit would increase. And again, if the investment return was below that 5%, the benefit would decrease. So that's a bit about the assumptions and the provisions that went into the plan. So what we're doing is we're comparing the current plan to the new plan. And so under the age 25 hire, pilot flies 35 years to age 60. The annual pension on the current plan is that $130,000. And the 130 you're going to see often, that's that 25 years service, that's a cap, times 260,000, that's the final 5-year average cap, okay, times the 2%, and that gets the 130. Under the variable benefit plan, same individual is expected to earn 290,000 as a pension, and these are all annual benefits. So you could see a percent increase of 124% over the current plan. And the real horsepower comes from any additional years flown over that 25 years of service and any pay earned over the 260 cap. So once you're hitting over that 25-year mark and earning over the 260, that's where the new benefit plan really benefits the pilots. If we go over one column, now we're assuming that a new hire pilot comes in at age 35, so just 10 years later. So the math is pretty much the same, but has 10 years less of benefit accruals. Flies to age 60, that's 25 years. And you could see that the the current benefit is still $130,000. Under the new plan, still an improvement, $179,000 annual pension, so a 38% increase over the current plan. The last column, we have an age 45 hire, flies to age 60. Current plan would get about $78,000. The new plan is very similar, $80,000, so a slight increase over the current plan. The reason why those two numbers are so close is because that 45-year hire didn't hit the 25-year cap at age 60. Okay, so still accruing under that current plan. If we shift over to the right side of the analysis, very similar, but now the pilot is flying an extra 5 years, so retiring out to age 65. And the numbers are just all improve over the prior three columns that we reviewed. And again, that's because the more you work and hit over that 25-year cap and earn over the 260, the new plan is going to benefit. And you can see in this example, the pilot at age 25 higher and 35-year higher, their current plan benefit is still the 130. So it's 130 if you retire at 60 or 130 if you retire at 65. So that pilot has flown an extra 5 years and has got nothing in terms of retirement. And again, those are because of those caps that are in place. Under the variable benefit plan, there are no caps, so you fly an extra year, you accrue an additional benefit, your variable benefit goes up. And you can see the last column, age 45, retiring at age 65, current plan is $104,000. And now the annual pension under the variable benefit plan, so the new plan, is $133,000. So a 28% increase over the current plan. Versus when we looked at it 5 years prior at age 60, it was only a 3% increase. So that really tells you, again, keep on stressing this, but the more you work and hit to that at age 25 years of service or more and earning over that 260 cap, you're going to benefit from the new plan. This is all based on historical returns. So again, from 1999 through 2017. We don't know what the investment return is going to be in the future. Okay, we could put an expectation around that and how that might vary. So this next slide takes a look at that age 25 hire, but rather than looking at historical investment returns, we look at it what's called on a stochastic basis. So we say, all right, we're going to expect the investment return to be 5% expectation, and we're going to put a variance around that, so a variability around that 5%, because we know we're not going to hit 5% year over year. So we're going to put a variance around that. So we're going to let that 5% float up or down over time. And we're going to run through 1,000 simulations to develop this chart on a stochastic basis. So what this shows is the current plan versus the new plan, same type of underlining provisions, so that 2% floor benefit accrual, 5% hurdle rate. The salary increases, what we talk about here is a career progression scale. So going from first officer to captain and narrow body to wide body. So those expectations of future salary increase step-ups are built into the projection and the salary. And so you can see in the current plan benefit that age 25, it's still $130,000, and it's a flat line because it does not vary with any investment return. The new plan is the black line and the colored bars. The black line is the 50th percentile, so on average, the pilot would expect to receive the numbers shown on that black line. And that is also the floor benefit. So if we expect a 5% return year over year, and if the hurdle rate is 5%, that means we're hitting our target year over year, so that variable benefit would not move up or down, and it's just set equal to the floor benefit. And so that's what that black line is. Now, in this scenario, there's no downside risk to the pilot, meaning you can't have a benefit lower than that black line because you're at the floor benefit guarantee. There's only upside potential due to the investment returns. And so what these bars, if you take a look and add up the probabilities in these bars, there's a 45% chance that the pilot's benefit would be greater than the black line at every retirement age shown from age 60 to 65. So there's a 20% chance that the pilot's benefit would be in that dark green. There's a 15% chance that the pilot's benefit would be in that lighter green. And there is a 10% chance that the pilot's benefit would be in that yellow. But again, this really shows the horsepower on that variable benefit side with investment return earning over that 5% hurdle rate. And you have the downside protection because of the floor guarantee. So previous slide, we just looked at a snapshot. So that age 25 higher retires at age 65. Snapshot was about $350,000. But there is a potential to earn an annual pension of, call it $575,000, the top of the dark green bar at age 65. This next slide, very similar, but age 35. So again, the should be purple. So the purple dotted line is the current plan, and that's $130,000. That's the cap. That's the annual pension. That's the maximum that a pilot can earn under the current plan. Again, that does not vary because it's a straight line because it does not vary with investment return. And then the black line is the 50th percentile. So on average, the pilot can expect that black line. Their benefit cannot fall below that black line because of the floor benefit guarantee. And then there's just all upside potential, a 45% chance that the pilot would receive an annual pension in excess of that black line. Where it gets interesting is that age 45. If you recall a couple slides ago, age 45 new hire, flying to age 60. Okay, so that's 15 years of service. We saw actually a 3% increase a couple of slides ago. So on this slide, we actually see a slight decrease from the new plan benefit to the current plan. So the dotted purple line is slightly higher than the black line at age 60. The reason why it's slightly different from a couple slides ago is because we're using a different investment return. Okay, we're using that 5% return on this slide with expectation of variation in the future. But although at age 60, the black line, that floor benefit, is lower than the current plan, you still have all that chance of earning a higher benefit. So basically all that in that dark green. So the new plan benefit could earn all the way up to $100,000 in an annual pension at age 60. So there still is upward potential there. As a pilot works to age 61 and then actually age 62, the current plan and the new plan benefit on average is basically the same. But under the new plan, you still have the opportunity, the chance, a 45% chance of earning in excess of that current plan, all the way up to the $120,000. Similar with age 63, and then age 64 and 65, the new plan is going to provide a higher benefit than the current plan with 45% chance of that upside potential. Told pilots like to get in the weeds a bit, so this slide has a bit of details there. We're going to take a step back and just look at how that variable benefit mechanism works with the shares and the share prices. Okay, so I'll walk through this exhibit, and this is just an example. So similar assumptions and provisions as the prior slide. So we're talking about a 5% hurdle rate. So again, the actual investment return, if it's over that 5%, variable benefit increases. If it's below the hurdle rate, variable benefit decreases. Variable benefit cannot decrease below the floor guarantee. And the floor guarantee formula is 2% times compensation up to that IRS limit, which is already over the 260. There are no other caps, no service caps, no artificial 260 cap. So in this example, we're looking at calendar year 2018. For example, a pilot earns $250,000. The IRS limit is $275,000. So when we do the calculations, we have to use the minimum of those two. And it actually, in this case, is just the pilot's pay of the $250,000. And then we apply the floor accrual rate, 2%. So 2% times the 250,365 is an annual floor accrual for 2018 of $5,007. Now, we're going to convert that accrual to shares. And in order to do that, we have to take the accrual and divide it by a share price. And so when the new plan starts up, the share price is just set at $10. So we take that annual accrual, we divide by 10, and we get the number of shares, 501. And so, for example, 2018, we say, all right, fund earned 7.5%. And again, that is professionally managed investment consultant and investment manager, professionally managed money. So the fund earned 7.5%. The target was that hurdle rate of 5%. So we beat that target by 2.5%. So now at the end of 2018, the share price is going to increase 2.5%. So we go from a $10 share value at the beginning of the year to $10.25, a 2.5% increase at the end of 2018. The benefit that the pilot has accrued at the end of 2018, so this is just looking at 1 year, it's going to be the number of shares, 501 shares, times that end of the year share price of $10.25. And so that math is 5,135. And that is the benefit that has accrued in 2018. And if we just carry these steps out just one more year, 2019, we have a salary of $275,000. We match that up against the IRS limit. We take the minimum of the two. It's still the $275,000. We apply the floor 2% accrual rate. So $275,000 times the 2% is $5,508. Then we divide that accrual by the share price, that $10.25, to get the number of shares accrued in 2019. So that's the 537. So at the end of 2019, at the end of 2 years flying, the pilot has 1,038 shares. If we look at just isolating the 2019 benefit accrual, that's going to be the 537 shares times the share price at the end of 2019. And so what is that share price at the end of 19? So we look to see what the assets did for 2019 in the pension trust. And so in 2019, for example, we've only earned 3%. We were targeting that 5% hurdle. We only earned 3%, so we missed it by 2%. So now the share price has to decrease 2%. So we go from 10.25, we decrease that down 2% to $10.05. And so that's the share price at the end of 2019. So we think about the benefit accrual for just 2019, it's the 537 shares times $10.05. And so that's the $5,397 accrual for just 2019 flying. If we think about what the pilot has accrued at the end of 2019, so just flying for 2 years, what is their benefit? So it's the 5,397 for shares accrued in 2019 plus the benefit accrued in 2018. And so that's just the shares in 2018, which is 501, times the share price at the end of 2019, which is that $10.05. And you do that math, and that's the $5,000 and $5,035 in the 2019 column. So we add up the 5,035 and 5,397, and we get 10,432. And so that would be the pilot's accrued benefit after flying just 2 years at the end of 2019. So we're summing down. That cell is red purposely because that variable benefit is actually below the floor benefit. The floor benefit, if you recall, is just 2% times salary. So this is the floor benefit, 2% times the salary. So you just keep on adding those pancakes up each year, and that's that floor benefit. So if we add up the 5,007 and the 5,508, that gets to the 10,515, and that's the floor benefit after 2 years. And so the new plan would pay the greater of the two, which is 10,515 in this case. And then you just carry through the same math year over year. And so at the end of this example, after 5 years flying, you sum up at the end of 2022. So the variable benefit would get you an annual benefit just after 5 years of 28,891. The floor would be 28,315. And since that variable benefit is greater than the floor, the pilot would have the greater of the two, the 28,891. And so that's how the shares and the share price works. That's how the accrued benefits underlining those projections that you saw work in the calculations. And this is dictated by the IRS, so these are hard and fast rules on how you have to do these types of calculations.